Pavel, welcome back to F.A.C.E. Great to have you.
Do you hear me?
Got you loud and clear, Pavel.
Great, because
welcome back.
With the Zoom.
So last time we talked, you were interested in bull spreads and sugar, and they worked out for you. So, I always look forward to you being here, Pavel, because you come here with like some conviction on a position that you believe in and your work is pointing to, and curious what's on your radar today.
Thanks, Dale. So I decided that I will not speak about some specific opportunity because, frankly, if you look at the price action on Friday, it was everything up, dollar down. So
Yeah.
we are heavily influenced by macro, and of course, yes, it is possible to find some uncorrelated opportunities. The spreads, like the sugar spreads I talked about last time, was a good example. But overall, in this environment, it is critical to get the macro picture right. If you get the macro picture right, it doesn't matter what commodity or what, I don't know, sector or index you pick, because the macro will be a tailwind.
Yeah, so you have the tide. You have the tide going with you. You have
yes,
the wind.
Definitely.
You have a tailwind instead of a headwind.
Yes, definitely. That will be critical in the upcoming.
Well, it sounds to me that you're talking about macro, that maybe you think this dollar pullback or top or correction is going to continue, and a weaker dollar may lift all boats. Am I guessing right?
Yes, it definitely looks so. We have been bullish, well, not exactly bullish, but short-term bullish definitely. But when the stocks were near the lows, there was a clear panic, and everybody was expecting the continuation towards 3,000 on SPX. Yeah. And we clearly disproved that, and we've been right. But I want to focus more on commodities and the rates and what is the relationship with the current macro environment. So I prepared a few charts. Maybe I will start with these two.
I find it interesting that you have the beans in there because, I'm a big believer in the grain complex now with the fundamentals. I can't find anything constructive that's, I don't like bull markets and grains because I know the implications are for what people are going to have to pay for everything else food wise, so, but they look like almost an investment class is the way I'm starting to look at agriculture.
Yes, I like beans, especially the meal, but these are not, these are signals generated by a machine learning model. So it's just like a black box, and their purpose is only to alert you about these potential opportunities. Definitely, I would definitely avoid trading them outright. But yeah, soybeans, especially the soybean meal, looks really good. The soybeans probably one of the best among the major grains from the seasonal point of view, positioning and so on. So I agree with your conclusion.
Okay. So I'm through interrupting you for a while.
No problem.
Tell us what you wanted to say to us today.
So I will start with rates, specifically the Eurodollar, which is basically futures on 3-month USD LIBOR interbank lending rate, and it's a critical market because it highlights what the cost of the money will be in the future, at least from the current market perspective. And you can see the current term structure curve for Eurodollar, and by the way, the curve goes well into the future, but I will focus on the upcoming or on the next 5 years. You can see the expiration on the horizontal axis and the prices on the vertical axis. If our watchers are not aware or do not know these interest rate markets too much, you can calculate the expected interest rate by subtracting the number from 100. So, for example, I have I don't know, December 2025 contract that is trading roughly at 96, which means the expected interest rate is 4%. So the lower the dot is, the higher the expected interest rate on this really important interbank market. And there's been a clear shift towards higher rates, which will be clear if I show you the situation a week ago and a month ago. The curve has been shifting lower, which means that market is expecting higher interest rates. As I said, the price is negatively correlated to the expected interest rates. So that's a major move. And the fact is, the market is really tight. You know, the monetary policy and everything else is really tight. It will be clear when I show you, for example, the 15-year average, which means how the curve looked like over the past 15 years at this part of the year. Or maybe I can even show you the 30-year average. Two things are clear. The curve tended to be much higher, which means that interest rates were generally lower. It's not surprising given the long cycle since the 1970s. And the second thing is the shape of the curve. You can see that currently the curve is upward sloping. Historically, it's been downward sloping. That's once again not surprising, because downward sloping curve means that the market expects higher interest rates in the future. That's a normal state of the market. And right now we have the opposite. We have the market that is pricing a huge tightening in monetary policy or general market conditions and gradual return to normal. And that is where this chart would be helpful. And this is something I watch very, very closely. This is a spread between December 2023 and 25 Eurodollar, which is the blue curve. And this is a continuous price, basically an artificial time series assembled from past expirations. So when you hover over the red curve, you can see it's actually 24 minus 22, and the orange curve is 23 minus 21.
And these are Eurodollar rates, not Eurodollar FX, right?
These, yeah, of course, yes, we are talking about.
I just wanted
rates.
to clarify it for the audience that this is 90-day paper in Europe.
Yes,
right?
Definitely.
Okay.
For the dollars held offshore the U.S. banking system. This is the most important futures contract around the world. By the way, this is also the most liquid. Nothing is close, not even S&P 500 or crude oil, nothing.
Treasuries aren't anymore.
Yes.
This is cheaper. Okay.
So I will zoom out, and this is why I'm talking about all of this. I got a few questions, both on Twitter and elsewhere, whether this bounce in commodities and other assets is sustainable. And I think this chart provides the answer, because in my opinion, the answer is no. Simply, the monetary conditions have tightened so much that when you take a look to the past instances when the curve was inverted, which means that when the value is positive here on this chart, it means that the interest rates, the December 23 interest rates, the expected LIBOR interest rate is higher than December 25. That is what I was talking on this chart. Remember,
so that's extremely restrictive, is what you're saying.
Yes, extremely restrictive. So the market expects that the rates in December 2023 will be higher than in December 2025. Remember, this is negatively correlated to the interest rates. So whenever that happened in the past, we got either recession or a major risk-off event, like after 2019 or in the recession in 2008, or I can even zoom out and you can see the inversion in June 2000. So
Okay.
that is the reason why I think this bounce in commodities is not sustainable. And maybe I can show you the crude oil itself as the most important commodity, because there's a lot of bullishness about crude oil. And we agree in the long term. We've been incredibly bullish energy since October 2020. We called it opportunity of this decade, and we've been right so far. Even in October, just a month ago, in our quarterly macro outlook, we told our users that we are short-term bullish crude oil. But the problem is such conditions usually lead to a risk of event, and a risk of event is not favorable for anything, not even crude oil. So when you take a look to the past instances when we get this inversion on the euro-dollar curve or this particular spread, you can see that
it's never been this extreme. Is that correct?
Yes, that's another thing. It has never been this extreme. That's another point.
Okay.
So
You know, that's what's fascinating to me, is look at the breaks you got when it was, you know, just a shade over zero. I don't see any one readings.
yes,
But where do you
definitely.
have to go? Is this historical right here? Or do you have to go back to like 1980 to find
Basically,
readings like this?
1970s. Basically, you have to go to 1970s
Okay.
to the Volcker
Interesting.
Fed, and
Yeah.
you know
All
that was
right.
the
I
last
thought.
true hike cycle because you know,
Yeah.
ever since we have interest rates that are trending lower. Of course, there are periods of tightening, like in 2000 or 2005, 6, 7, or from
Yeah.
2015 to 2018. But the
But
point
that was
is,
just fine tuning instead of a real policy,
yes,
right?
because every time it happened, the market or
They,
the economy, more importantly, the economy was unable to sustain higher interest rates,
yeah.
and that's the reason why we've been in a very long, not
Retu-
tightening.
yeah. The others were tinkering because they were
Yeah,
bored at the Fed.
we've been in a very long cycle of loosening
Yeah.
monetary policy since the 1970s. So the situation is not different from the perspective of the amount of debt. The amount of debt after the recession in 2008 is not
Okay.
smaller, it is higher actually. It only
Yeah.
went from, in 2008, the debt went from the balance sheet of banks and basically corporations to the US government. In
Right.
2020, it was similar, only that the debt went from the balance sheet of people to the US government. Basically, all the stimulus checks, and that
Right.
was only about debt reduction. You can see the student debt in the U.S., the Sally Mae, and the Biden administration.
Oh, yes. Okay.
Uh,
Where's it
you
going to
know,
go this time? Are we looking at the most hated market right now, are bonds, Pavel? I mean, you know, people have gotten cremated, eviscerated in the bond market.
I
But
don't know, but I have
if we're going
another.
to have a risk
Yeah.
off event like this, and the magnitude is big enough, are bonds the buy of the decade down here?
I wouldn't buy bonds personally because
Okay.
the current environment is different. This is we have a high inflation, which is something
Okay.
that was not present in the past cycle. So definitely the bonds. I have the 10-year treasuries over here are really oversold, and I'm watching the Japanese yen as a proxy for the 10-year.
So whose balance sheet does it go to this time during this event, this risk off event?
Yeah, I
You
mean,
look,
there's
go
a
ahead.
consensus that there has to be a monetization of the debt and basically printing money to solve the debt. Maybe that's possible. Maybe they will do it. I don't know, but I prefer to follow the data. And even if we will have some kind of monetization on a wide scale, which is basically something that was happening since 2020. it is not immediate concern because right now the monetary policy is tightening. So first we need to, I think first we need to have a turnaround on this curve like it was in 2007 or in 2000, which would spark a risk of event, because once this curve turns lower, that would mean the things are starting to break down. And only then it would be acceptable politically and socially to have a wide scale debt monetization and money printing. So I prefer to focus on the data. Right now the data says the monetary conditions are tightening, and yeah, I forgot what I wanted to say.
That's okay. Yeah, so it's never been tighter since you've been doing this.
Definitely,
Monetary
definitely.
conditions.
It's never been tighter. It's really unprecedented. So as I said, I want to focus on crude oil because our software and our firm is mostly focused on commodities, and crude oil is clearly in the spotlight. And there's a lot of bullishness about crude oil, but as I said, we have been bullish since October 2020, and we are bullish short term. But in the medium term, the crude will probably get slaughtered with the rest of the market once we get the risk of event. And I'm closely watching the contango. This is actually the backwardation between the 4th and 7th contract on Brent futures. There is no reason to pick these two particular contracts, but I want to move away from the near end because the near end is noisy and there's a lot of speculation on the near end. The mid to back end is less noisy, and you can see that the backwardation currently is slightly elevated from the historical perspective because it is above the 75th percentile and below the 95th percentile when I look at the histogram at the top subchart. And backwardation is usually, or basically nearly always, connected to physical tightness. That's correct.
Right.
But once we get an extreme backwardation, that isn't sustainable. When I zoom in to the last 2 years and move out, you can see the backwardation spike at the beginning or in March this year. And that was the local top in crude oil. So I would not be so excited by the extreme backwardation in crude oil. So I will be watching this chart, the continuous contango for crude oil, to see two things. First, if we break above 4%, because that is clearly an important level, you can see it around here. Once again, I have no reason to pick these two particular contracts, so the level would be elsewhere on different combination, but that's not the point. The point is that the contango is the volatility of this curve or of the backwardation contango is tightening, it is moving down, and something will happen. So if we break higher and backwardation spikes higher, that would mean the price of crude oil would also spike higher. But it most likely would be the last rally before we get risk off. And I think the situation in 2008 or prior to the sell-off in 2008 is very interesting because you can see that there was a clear divergence between the backwardation and the crude oil. The physical market was getting loose while the price was rising. That was a clear speculative behavior. And once again, I'm not saying it will be similar this time because the market is clearly different right now. I have another chart that will prove that, which is the 3-to-1 crack spread, actually the December crack spread. And it shows that demand for products is really huge. It is approaching levels, not approaching, it is at levels we have not seen before, and we can compare the current level with the level in 2008. So That is really
Another
incomparable.
extreme.
Yes, another extreme. And keep in mind, the price of crude oil itself was higher back then. You
Yeah,
can see it here. The price of
right.
crude oil was approaching $150. Right now we are below 100, and the crack spread is way higher. So this market is really different. That's the reason to be bullish crude oil or energy long term. But yeah, I will be following the contango, and I'm really interested to see how this situation evolves. I will also show you the Oman crude oil contango because there is a very similar level, very similar price action. The backwardation is more elevated here. We have just 15 years of data compared to longer history for Brent and WTI. But overall, when I zoom in, you can see a very similar price action. It is also around 4% backwardation. And if we get a break higher, that would mean that crude oil breaks higher and we get another
So,
leg higher.
so let me ask you this, Pavel. I think that we could rally above 100, maybe trade 108, which would be the second lower high. We had the peak at, on the invasion, then we had a failing rally, and now we're trying to recover again, but I don't think we approach either of those highs. Do you think the S&Ps will give us a kind of a feel for the top in crude, or you think crude will lead it? What do you think? Commodities break because of a risk-off event in equities, or vice versa?
I think that the stocks would lead, but
Okay.
once again, it's a weakly held opinion because last time crude was holding really well. I can add
Yeah.
S&P 500 here so that we can compare these two charts. And right now, the energy is the cause for many of our problems. So it is only natural to
Yeah.
expect that it will be stronger than the rest of the market. And you can
Okay.
see it here, the S&P
Yeah.
was
Topped
selling
way
off
before it. Yeah.
way before
Way
the
before.
WTI crude oil. But
Nice.
keep in mind, we are already, the stocks are already selling off. So this trend is already underway. So it's important to realize where are we in this cycle. So you can see it here. The stocks were selling off, but crude oil was making highs. So it's,
But do you see what I'm saying? You know what? I like the gap fill at 110 for a sale in crude.
Definitely.
Thank you for showing me this chart. Huh?
That's definitely possible.
All right, so let's mark that down.
Yeah, it's a continuous chart connected
Yeah.
by maximum open interest. If I switch to the connected the contracts connected by expiration, it will look slightly different. But I think 110 on WTI is it's quite reasonable. But I would, as I said, I would watch. I will watch the contango very closely because either it breaks higher and we get the last spike higher, or if it continues to roll down, that would be really bearish because that would mean the same scenario like in 2008, and we all know how that turned out. So.
Okay. So actionable wise, am I reading you correctly that you're just watching this bottom chart here to give you an idea of when the crude might revert back to a downtrend and then look to take advantage of the decline?
Yeah, I mean, I would probably not short crude oil simply because, as I said,
you could go
we
broke.
continue to be long-term bullish crude oil. You do not short something, you are long-term bullish. The underinvestment and all the things related to capex and these issues, they are present and they will be present for years. This is not something that this is what we told our users in 2020. The bull market in energy is not something that will last a year or two. It will last
10.
probably a decade.
Okay.
So
Yeah.
I would not short crude oil. If I have to short something, I will pick something else.
Stocks.
Either stocks or something that's
Silver.
Yeah, definitely. If we get a risk of event, silver will get murdered. It was
Right.
it was like that every time. But I would look for the weak parts of the market, not the strongest parts. So I would not short crude oil. The message is that I would avoid building massive long positions in crude oil right now. Yes,
Okay.
doing small speculations, that's totally fine. But the current sentiment on Twitter and elsewhere regarding crude oil tells me that many people are really going all in to crude oil or energy in general, and that's not the right time to do it. The right
especially
time was
the stocks. I mean, the stocks are outperforming the commodity.
Precisely. If we get a risk of event, the stocks, the energy equities will get murdered. That would be much worse than the crude oil itself. So this sentiment tells me that people are piling into energy at the wrong time. So the right time was in 2020, maybe 2021.
So what? They're 2 years late. What's a big deal? Took them some time to wake up, buddy. Anyway,
yes.
All right. So I really love your work, Pavel, and I've invited you to be where I do interviews anywhere I go. So why don't you show people where they can find you and check you out, and you even have some free things out there. Show your website, and
sure.
And so really the message is that Pavel's getting out to you guys. Don't get too bulled up in crude, and there could be another shoe to drop in crude. I know a lot of people that are, say that we could, what was the recent low in the 70s? That we could see $60, $50, $40 crude. In an event like that.
If we get a risk of event, we can easily see such prices. They would not be sustainable in the long term. That's right. That's certain. But in the short term, when the liquidity dries up, everything that gets liquidated. So so you can always follow our research and use our software when you go to spreadcharts.com. We have a software for commodity markets, and not just commodity markets, as I showed you today with the interest rates. And you can sign up for our software. We have a free and the premium version. Even the free version is very powerful because you get access to all the data and most of the charts. In the premium version, you would get our research, those signals generated by the machine learning model, and some advanced charting features. Maybe one last thing I would like to say, and we already talked about it last time, is that one thing I'm really positive in the medium term, going into the potential risk of event, is volatility, because it's the relatively cheapest asset right now, and maybe the only one that is trending higher.
Yeah, and you know what? And you're probably right, because people are so disappointed buying the VIX with all these breaks that we've had, and it can't get over 40, that they're probably discouraged, through the last year being long VIX and not having a payday.
Yes, that's exactly right. Everybody's saying that VIX is broken. Yeah, VIX is broken.
It's broken. Yeah. So next time we get through, what was it, 32? We could see 40, 50, maybe a spike in vol. Huh?
Definitely. And I prefer to follow the VIX futures, and the price action on the mid to back end of the curve is really interesting. This is the fourth continuous VIX contract. And you can see how it is trending nicely higher. So that's clearly one of the best opportunities, maybe not immediately right now, but in the medium term, definitely. So we made, by the way, we made a video about this opportunity in VIX. I guess it was, well, I don't know what it was, but I think it was this. Is it the bear market rally? Yes,
Okay.
that has a volatility tag,
Right.
where I presented a strategy that, in my opinion, will work really well next year, because trading volatility is hard. Your timing has to be perfect. So I developed a strategy, or devised a strategy that will make well even without precise timing. Basically, I focused on trading the state of the market instead of the underlying itself, instead of the spikes. But
Send me that link on Twitter to me, okay? And really, I have to run now. So watch the VIX. Look for a risk-off event, very tight, restrictive monetary policy, almost unprecedented since the 70s. And don't get bulled up too much in crude oil. Short, intermediate term, short term. Am I reading you right?
Yeah, clearly. And the reason is basically this chart. So
Yeah,
I think it's pretty clear.
That is definitely, when you look left and you see nothing close to it, it leaves an impression.
Yeah.
So Pavel Hala at spreadcharts.com. Thanks for enlightening us once again.
Yeah, thank you, Dale. It was a pleasure talking to you.
Okay, so Pavel Hala, you can follow him at spreadcharts.com, on Twitter. He's very good. He's very good.
Thanks.
Okay.
Thanks, Dale.
All right. That's a wrap, everyone. You could join the team in 10 minutes for the morning edge. I'll see everyone. You're being thanked. See everyone tomorrow for Turnaround Tuesday and a blood moon, full moon, lunar eclipse tomorrow. So get in your pyramids and put on your tinfoil hat. But most of all, don't just count your pips, count your blessings. Adios. Thanks, Pavel.
Thank you, Dale. Bye.
All right. Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.